Good evening, friends. Today we are going to take a very important standard, IND AS-109. IND AS-109 is called financial instrument, and as you know, you will get a question on this standard definitely. It is believed that this is a difficult standard, but actually it is not the case. If taught properly and if learned properly, then you can make it a scoring topic. Today is the super fast revision of financial instrument. We will not be taking numerical questions, but we are going to cover all important concepts. In fact, all concepts we will cover which are highly tested in the exam. I will also give you the journal entries to be passed for different situations. So this will be very useful to you. One day before the exam, you can just watch this video and this IND AS-109 will be completely clear. IND AS-32 we have already covered. So now we'll take this standard IND AS-109. So please pay attention. First we'll see what is the guidance covered by IND AS-109. So IND AS-109 covers recognition principle, derecognition principle, classification principle, measurement of financial instrument, impairment, and the last part is called hedge accounting. So this is our topic that we have to cover in IND AS-109. So first question is, when should financial asset be recognized? When should I bring financial asset in my book? Financial asset will be recognized in the books only and only when the entity becomes party to the contractual provision of the instrument. So that means the entity becomes a party to the contractual provision. So it is having rights and obligation under the contractual provision of the agreement, and on that date that financial asset would be recognized. In this chapter we are going to talk more about financial asset. Financial liabilities we have covered in IND AS-32 in detail. If you have not seen the video, you can watch the video on the YouTube channel AS Foundation Financial Liability. So before I proceed further, I just need to inform you for the benefit of a large number of students that we at AS Foundation, we have an app called Vino. In this Vino app, for limited period we are having a scheme called 1 rupee loot. You can download the app and you can get this books for just 1 rupee. You can watch the books in your app itself. So the books available are FR books, class note, summary chart, quick revision, compact, SFM practice booklet, summary book, formula book, FSCM book, case study digest, similarly risk management and GFRS book and case study digest. You can also view these books on your Apple phones, Apple devices also. For Apple users, download Class Plus app and use the code KWUDA, that is our educational institution code for this Class Plus app, and you will be able to access the video. So now we are also available on iPhone or iPad. You can watch our video lectures, you can watch our books, you can read our books on iPhone or iPad and Apple devices also, but you just have to download Class Plus app and put the code KWUDA and you are ready to go. So download now today this app. If you are Android user, just go to the App Store and write Vino, that is enough. So we'll see now classification of financial asset. Classification of financial asset would be cash, very easy, no special accounting required. Derivative, Usually at FVTPL, investment in equity instrument we will see in detail, and other financial assets like receivable, advances, loan, investment in debt and investment in preference shares. So first quickly I will tell you about derivative. We will discuss about derivative in detail subsequently also. Derivatives are always measured at FVTPL. FVTPL means fair value through profit and loss account. I am not talking about cash because cash you don't require any special accounting. Investment in equity instrument. The standard says it will be FVTPL. Investment in equity instrument will be at FVTPL, but there is some exception. In those exceptional cases, investment in equity instrument can be classified as FVT OCI also, fair value through other comprehensive income, and we are going to cover equity instrument in detail after some time. And what about other financial asset? So derivative always FVTPL, equity instrument usually FVTPL, but in some exception cases FVT OCI. What about other financial asset? So as per IND AS-109, other financial asset will be divided into three types. One is called amortized cost category. Second is called fair value through other comprehensive income. Third is called fair value through profit and loss account. A financial asset will be categorized as amortized cost category if it passes business model test 1 and contractual cash flow test. It will be classified as FVT OCI if it passes business model test 2 and contractual cash flow test. If it does not fit into these two category, then automatically it will get categorized as FVTPL, and in case of accounting mismatch also, which I had covered in IND AS 32, it will be treated as FVTPL. So now the student will ask, what is business model test 1, business model test 2 and contractual cash flow test? So let us understand, when are other financial asset categorized as amortized cost, FVT, OCI or FVTPL? So condition for classification of financial asset. So we have to perform two tests to check the classification, whether it will go to amortized cost or FVT OCI, and these tests are called business model test and contractual cash flow test. Remember, this is a super fast revision, so therefore I am expecting you have read this standard once, and today we have come here for revision purpose only, so that the whole chapter goes before your eyes in just 1 hour. So first we will see business model test. What is business model test? That means what is the policy of the company with respect to that financial asset? What is the objective of holding the financial asset? So there are two possible objectives. One is called BMT1, business model test 1. Here the objective is to obtain contractual cash flow from financial asset on the specified due dates. That means whatever interest plus principal which have been agreed upon, the objective is to collect it on those days. The objective is to receive all cash flows by holding it, not by selling it. That means you want to just hold it till maturity and get all the promised cash flow. The cash flow will be in the form of interest and principal. The second objective of holding financial asset can be to obtain contractual cash flow and by selling it also. That means you are keeping both the option open. You want to hold it also, and if need arises, if you want, you can sell it also. So there is no requirement to hold it till maturity. So if that is the objective, then we will call BMT2, business model test 2. And then the next test is called contractual cash flow test. So BMT1 plus CCFT will be amortized cost. BMT2 plus CCFT will be FVT OCI. So what is common in both? What is common in both? The common part in both is CCFT. Okay. So contractual cash flow test, under this test financial asset is analyzed to identify contractual cash flow. If financial asset is capable of generating cash flow which is solely due to principal and interest on specified period, the contractual cash flow will cover only the principal and the interest on the specified date, then we will say contractual cash flow test is satisfied. So principal and interest are generated from that financial asset on specified dates, then we will say contractual cash flow test has been passed. In case of equity share, this test will not pass because there is no contractual cash flow. In case of derivative, this test will not pass because there is no contractual cash flow. But in case of debenture and bond, this test can be passed because they generate contractual cash flow in the form of interest and principal. It means financial assets should generate only principal and interest and on the specified date. So I am going to tell you that only debt instruments are capable of meeting the contractual cash flow test, like investment in debenture, investment in bond. Derivative asset and investment in equity instrument will not be able to meet the contractual cash flow test because there is no contractual cash flow and there is no specified date also. Now next issue is measurement of financial asset and accounting treatment. So now we are entering into the main part of the standard. Up to this there was some basic discussion. Dear student, if you want to get this presentation, we have a book called FR Compact book. This FR Compact book contains the entire FR notes in simple language. The way it is appearing on the screen, it is written in the same way. You can purchase it from our website vinod.in. You can revise your entire FR in just few hours, 2-3 hours. You can go through it. It is presented in a very simple manner and you can easily read it. Readable font, student handwriting format. So I will highly recommend that you purchase this FR Compact book. This contains only theory. If you want to practice more questions, numerical question, you can purchase FR Compiler. It contains question from RTP, MTP, study material and past exam. And if you want to get summary book, chart book, so this is a chart book, summary chart book, where the all standard applicable in your syllabus is presented in the chart form. So FR summary chart you can purchase from website vinod.in. And one more book about which I will tell you later. So continue. Compact book, compiler book, summary chart you can purchase from website. Very useful book. You will not find such books in the market. It's only available on our website vinod.in. The student will now come to the discussion on the screen, measurement of financial asset and accounting treatment. So I will divide financial asset into two categories for accounting purpose. One is short term financial asset whose realization is within 12 months from the reporting date. And this discussion is not applicable for the following three items: cash, derivative and investment in equity instrument. We will discuss derivative and investment in equity instrument separately. Special treatment for derivative and equity instrument. It will cover short-term bond, short-term debenture, receivable, loans which have a maturity of less than 12 months. So what is the accounting of short-term financial asset? There are three categories possible that we have discussed already: amortized cost, FVT OCI, FVTPL. If it is amortized cost category, when it is amortized cost category, when business model test 1 plus CCFT is passed, then we will call it amortized cost. On the date of purchase, initial recognition entry will be financial asset account debit to bank account, being financial asset recorded, and the amount will be equal to amount paid plus any transaction cost minus any processing fees received. Then if it is a debtor, the debtor or receivable, then the entry will be financial asset account debit to sales account, and the transaction price will be as per IND AS-115. If it is FVT OCI instrument, same like amortized cost. If it is FVTPL instrument, in FVTPL instrument, the transaction cost is not capitalized. The transaction cost is separately charged to P&L account. Very important, it will come everywhere. So amount paid for financial asset account debit to bank, amount paid minus processing fees received, transaction cost account debit to bank, and transaction cost is transferred to profit and loss account. If fair value based on transaction is different from fair value as per level 1 input, that fair value as per level 1 input is covered by IND AS-113. So if there is a difference, that difference will be adjusted in P&L account if the instrument is FVTPL, and OCI if the instrument is FVT OCI. Now we'll come to year end. Short-term financial asset accounting at year end. If it is amortized cost instrument, interest will not be recorded because short term. No adjustment for change in fair value. In amortized cost category, no adjustment is made for change in fair value. Remember, an FVT OCI, interest will not be recorded. But if there is any change in fair value, that change in fair value will be recorded in OCI. The OCI reserve can be recycled. OCI reserve can be recycled when the instrument is derecognized. About that we'll discuss later. At the end of the year, fair value will be calculated without transaction cost. At the beginning I had told you, at initial recognition we take transaction cost also, but at the end of the year, the fair value will be without considering the transaction cost. And now FVTPL at year end, interest will not be recorded because it's a short term instrument, but if there is a change in fair value, it will be routed through P&L account. At the end of the year, fair value will be calculated without considering transaction cost. Now short term financial asset on settlement, that means when we are going to settle it, and if it is an amortized cost instrument, you will receive the amount on settlement bank account debit to financial asset. If there is any difference between book value and the consideration, you will transfer it to profit and loss account. if it is FVTOCI instrument, bank to financial asset, difference will be transferred to OCI reserve and OCI reserve will be recycled to profit and loss account. If it is FVTPL instrument, bank to financial asset and difference will be recognized in profit and loss account. So this was about short term financial asset. We have seen accounting initially, at year end and on settlement. You can watch this video again and again and you will understand. So I'll request you to watch this video one or two more times and all your concepts will be cleared. Now I was telling you we have one more book, fourth book, called the best book in financial reporting available in the country, and this is called Financial Reporting Class Note with Solution. You can see this book on the screen. So the important thing about this book is that it contains theory as well as the question and answer. The answers are presented in a very simple way, the way we dictate the answer in the classroom, plus tutorial notes are written at the end of the answer. So if you have doubt, you can read the tutorial note. If there is a mistake in the question, we have pointed out that also and why there is a mistake in the question. At some places we have given alternative answer also. So basically it will cover ICI, study material question, RTP, MTP, past exam question. At one place you will get everything arranged chapter wise. Within chapter also the questions are arranged concept wise. So honestly speaking, this is the best book on financial reporting available throughout the country. If you check it, only then you will realize how wonderfully it has been presented. So you can purchase this financial reporting class note with solution book from our website vino.in. Now we'll come to long-term financial asset. Long-term financial asset other than cash, other than derivative, other than investment in equity instrument, because derivative and equity instrument will be covered separately. So here also we will discuss three financial asset: amortized cost, FVTOCI and FVTPL. So we are now discussing long-term financial asset, amortized cost category, initial recognition. Same like what we have discussed in short term. Financial asset account debit to bank account, the amount is equal to amount paid plus transaction cost minus processing fees received. But because it is a long term financial instrument, we are going to calculate effective interest rate or EIR, because the interest will be recognized based on effective interest rate, and for that we will prepare one amortization schedule which will have opening balance, interest, cash flow and closing balance. So this is called amortization schedule, and the interest will be calculated here as per EIR, and contractual cash flow we will write as per the contractual arrangement. After the life is over, if it is a 5-year bond, then after 5th year the balance should become 0. So this is right now amortized cost. At the year end, what I'll do, financial income will be recognized using effective interest rate method. If it is amortized cost instrument, don't change fair value. Don't change fair value. However, valuation allowance can be made, means impairment or provision for doubtful debt, what they call it. The provision for doubtful debt can be made. What about the accounting and calculation? To be discussed after some time. Now we'll come to settlement. On settlement, the entries as usual: bank account debit to financial asset. Any difference will be transferred to profit and loss account. long-term financial asset which is FVT OCI category, on day 1 initial recognition same as amortized cost. Here also we will calculate effective interest rate. Here also we will prepare amortization schedule. At the end of the year we are going to calculate or find out fair value as per IND AS-113. So FVT OCI instrument, we are going to recognize finance income as per effective interest method based on the amortization schedule that you have prepared, and fair value at the end of the year, fair value at the year end will be without transaction cost. Any difference between carrying amount and fair value will be transferred to OCI reserve. OCI reserve will be later on recycled to profit and loss account. And now we'll come to settlement. That is when the financial asset is to be derecognized. It is settled as usual. Entry is bank to financial asset. Any difference will be first transferred to OCI reserve. From OCI reserve, it will be recycled to profit and loss account. Now we'll come to FVTPL instrument, long-term financial asset, classified as FVTPL. Initial recognition entry will be at only fair value. Transaction cost will be recognized in P&L account. Very important. In FVTPL, transaction cost is recognized in P&L account. In FVTPL, we do not calculate effective interest rate. We do not calculate IRR in FVTPL. So journal entry will be on initial recognition financial asset account debit to bank account, transaction cost account debit to bank account, and transaction cost will be transferred to profit and loss account. At the end of the year, fair value is calculated as per IND AS-113. Finance income is not recognized. Finance income is not recognized. Any difference between carrying amount and fair value, difference between carrying amount and fair value is transferred to P&L account. And on settlement of the financial asset, bank to financial asset, any difference is recognized in profit and loss account. So what we have covered till now, understand. First we have covered short-term financial asset. Then we have covered long-term financial asset. 3 categories we have discussed: amortized cost, FVT OCI, FVTPL. Now we are going to cover investment in equity instrument. Investment in equity instrument, that is investment in shares. Regular way of purchase. First we will cover regular way of purchase, and then we will cover other way of purchase. Regular way of purchase means they are purchased in an organized market. So what the standard says, investment in equity instrument will always be classified as FVTPL, but there are some exception. Under that we can classify it as FVT OCI. Regular way of purchase means they are purchased in regulated market or conventional market like Bombay Stock Exchange or National Stock Exchange, which is regulated, which is a conventional market. There are market timings, there are days when it is traded, there are procedure by which you buy or sell shares. First thing, remember, usually they are FVTPL, but company can designate, entity can designate it as FVT OCI, but that is an irrevocable choice. That is an irrevocable choice. Once you classify it as FVT OCI. Once an equity instrument is classified as FVT OCI, later on you cannot classify it as FVTPL. Okay, so make this choice carefully because this cannot be reclassified later. So it is like your CA course. Make the choice carefully. Later on, very difficult to reverse the decision. Okay. So usually if the financial asset is held for very long term, if it is for strategic reason, then the company call it as FVT OCI because they don't want to hit their P&L account every year. In any case, they are not going to sell it. Now next is, if equity instrument is held for trading or speculation. If the objective is trading, that means buying with the objective of selling immediately and making profit, or for speculation, then you cannot classify it as FVT OCI. Such instruments are always classified as FVTPL. But if the investment is for long-term strategic purpose, it will be FVT OCI. If it is FVT OCI, the change in fair value is also recognized in OCI and subsequently it is not recycled. Very important, if the instrument is equity instrument classified as FVT OCI, subsequently the balance in OCI will not be recycled to P&L account, but it will be recycled to any other component of equity. So within the reserve it can be transferred. If equity instrument is held for trading or speculation, always FVTPL, change in fair value in P&L account, and there is no choice. There is no choice to classify it as FVT OCI. So instrument held for trading or speculation will always be FVTPL. So this was our discussion on equity instrument acquired in regular way of purchase. Then investment in other equity instrument, that is which are not traded in the organized or conventional market, like you can acquire shares of some private company, shares of private company where there is no regulated or organized or conventional market. So what is the treatment for such other equity instrument? First of all, there is no major difference in the accounting. This will also be classified as FVTPL. Initially, it will be recognized at the amount paid, that is fair value. Transaction cost will be charged to P&L account. Any change in fair value will be transferred to P&L account. If the equity instruments are not purchased in regulated market, then it is accounted as follows. On trade date, it is treated as derivative. On trade date means the date you commit to buy or sell. So this is applicable for those equity instruments which are not purchased in regulated market. On trade date, it will be treated as derivative. That means any change in fair value will go to P&L account, and till settlement date, that is the date when you actually take the delivery and make the payment, it's called settlement date. Delivery and cash are done on this date. Till that date, it will be treated as derivative and it will be any change in fair values transferred to P&L account. On settlement date following, journal entry will be passed. Investment in equity account debit to bank account, being investment purchased. Such instruments are always classified as FVTPL unless otherwise mentioned. Any transaction cost paid will be written off in profit and loss account. At the year end, any change in fair value will be recognized in profit and loss account. On the sale of the instrument, bank to investment in equity instrument, and any difference will be transferred to profit and loss account. So that was the accounting treatment for other equity instrument which are not purchased by regular way of trade. Now we'll come to accounting for purchase in case of regular way of trade. Are you enjoying or not? First tell me that. If yes, then say yes, we are enjoying. So what is regular way of trade? That is, they are traded in regulated or conventional market like stock exchange, where we have timing of trading. There are settlement period. T+2 cycle is followed. Market opens at 9:15, market closes at 3:30. So in case of regular way of trade, we have two choices to do accounting. Equity instrument purchased in case of regular way of trade. Two choices you have. One is called trade date accounting and one is called settlement date accounting. This option is available each year. But whatever accounting policy you choose, you will apply that for all such equity instrument throughout the year, and it will be disclosed in the note. This option should be applied to all investment purchased in the regulated market in that year. So 1 year you can follow trade date accounting for all the investment. Another year you can follow settlement date accounting for all such equity instrument. Now for the simplicity, we have to divide into 3 columns. Accounting for purchase in case of regular way of trade. Now even a debt instrument can be purchased in regular way of trade. Then it can be classified as amortized cost, or any debt or equity instrument can be classified as FVT OCI or FVTPL. So we will discuss our accounting in case of regular way of trade in 3 columns. If it is amortized cost, if it is FVT OCI, or if it is FVTPL. Student will pay attention on the purchase of investment, and we are following trade date accounting. In trade date accounting, investment is brought into the books on trade date itself. That is the date when we enter into a contract. Like in BSc, if you enter into a contract on Monday, the delivery takes place on Wednesday. So Monday will be the trade date, Wednesday would be settlement date when the shares actually reach your demat account. So entry will be amortized cost. First column amortized cost, second column FVT OCI, third column FVTPL. Financial asset account debit to broker account, and the amount is equal to amount paid plus transaction cost. FVT OCI same, financial asset to broker account, the amount is equal to amount paid plus transaction cost. But if it is FVTPL, financial asset account debit, transaction cost will be debited separately, because I am not going to add it to the initial value of financial asset to broker account being investment purchased. So very important, the third column FVTPL. Now we'll come to year end. First column is amortized cost. There is a change in fair value, but if it is an amortized cost instrument, then we are not going to record change in fair value. But if it is FVT OCI instrument, then entry will be either financial asset to OCI reserve if fair value goes up, or OCI reserve to financial asset if fair value goes down. And same thing for FVTPL instrument also. Transaction cost will be first transferred to P&L account. Transaction cost will be transferred to P&L account, and change in fair value of financial asset will be transferred to P&L account. Now next is on settlement date. On settlement date, in all the three cases, the entry will be broker account debit to bank account being amount paid. Then on settlement date, if there is a change in fair value, on settlement date, if there is a change in fair value and if the instrument is amortized cost, no entry for change in fair value because first column is amortized cost. If it is FVT OCI instrument, then on settlement date we'll pass entry for change in fair value, financial asset account debit to OCI account if fair value goes up, or OCI account debit to financial asset if fair value goes down. And third column, the last column, is FVTPL column. If there is a change in fair value on the settlement date, we'll pass the entry financial asset to P&L account for value. If it is going up, financial asset to P&L account. If the value goes down, then P&L account debit to financial asset account. That was about trade date accounting. Now we'll come to settlement date accounting. This is little complicated because here we are not going to recognize the financial asset on the trade date in the books, but we are going to recognize it on the settlement date. So here also I will divide into three columns. First is amortized cost. On trade date, we will not pass any entry because we will recognize financial asset on settlement date. No entry in FVT OCI also, and no entry in FVTPL also. Now we'll come to year end. At year end, suppose there is a change in fair value. At year end, suppose there is a change in fair value. In amortized cost category, again no entry, no treatment. But if it is FVT OCI instrument and there is a change in fair value, we will open an account called fair value adjustment account, because financial asset is not there in my books right now. So temporarily we will open an account called fair value adjustment account to OCI reserve account. And if it is FVTPL instrument, we will pass an entry fair value adjustment account to P&L account if the value of the investment goes up. If the value of the investment goes down, we'll reverse the entry. If the value of the asset goes down, in the second and third category, we'll reverse the entry OCI reserve to fair value adjustment. Here P&L account to fair value adjustment. Next is settlement date. On settlement date, amortized cost category, entry will be financial asset account debit to bank, amount paid plus transaction cost. But if it is FVT OCI instrument, then financial asset account debit. Remember, we have created one account called fair value adjustment account to fair value adjustment account. That fair value adjustment account will close. Financial asset will be recorded at fair value. Any payment made to bank account and to OCI reserve balancing figure. And if it is a FVTPL instrument, then financial asset account debit at fair value to fair value adjustment account to bank account, and any difference on settlement date, the balancing figure will be transferred to profit and loss account. Now we'll have one important discussion which usually they don't cover in the study material properly or in the notes, is investment in bonds in foreign currency. What is the issue involved? The issue involved is two standards will become applicable here. One is IND AS-109 because it is investment in bond, so it will be categorized as either amortized cost or FVTOCI or FVTPL. So whatever we have learnt will be applicable, but it is also a bond in foreign currency. So IND AS-21 will also apply because it's a monetary item, and therefore we will have to revalue the investment using the closing exchange rate. So the question is, how much difference will go to the P&L account under IND AS-21 as exchange difference, and how much difference will be recognized as per IND AS-109. So let us see, very important tick mark. If they ask you a question on this, you have to be prepared in advance, otherwise you will not be able to solve it. Okay, many students are not able to understand this. What is this question? Such bonds can be foreign currency convertible bond or any bond in foreign exchange. If these investments are recorded at FVTPL or FVTOCI, so here we have one more challenge. We will have to measure the fair value. Then closing balance of the bond will be at fair value in foreign currency. So first calculate fair value in foreign currency and then you convert into presentation currency by applying the closing rate. So in case of FVTPL or FVTOCI foreign currency bond, fair value will be calculated in foreign currency first, then multiplied by closing rate to convert into presentation currency. Then you calculate the closing balance at book value using closing date exchange rate. Closing balance at book value using closing date exchange rate. Difference is transferred to exchange difference. Difference transferred to exchange difference to be transferred to P&L account. So the difference between book value and value based on closing rate will be transferred to P&L account. Step number 2, then this instrument will be measured at fair value. Here we are only transferring the book value and the closing balance based on closing rate to P&L account. Here in step 2, we are calculating the fair value of that bond first in foreign currency, convert it into closing exchange rate, and this difference will be recognized either in OCI or P&L account, will depend on the category of the investment. If the category of the investment is FVTOCI, then the fair value change will be transferred to OCI. If the instrument is FVTPL, then that fair value change will also be transferred to profit and loss account. So two differences will arise here. One difference is because of exchange difference under IND AS-21, and the other difference is due to change in fair value. The exchange difference part will always go to profit and loss account. The fair value part will go to OCI or P&L account depending on classification. In our notes, we have a question on this where we have solved a problem by using all three categories, and that will help you to understand. Right now we will not be able to take the numerical question. It will take a lot of time, but requesting you to read from our class notebook or our compiler, you will find that question. Now the next part is special cases of advances which are at off market terms. That means which are not at normal commercial terms. And what are the questions they usually ask? This is a highly tested area in the exam, staff advance. Another area which they will test in the coming exam is security deposit. Third is loan between parent and subsidiary, which is either without interest or at a lower interest, and other loans which are at off market terms. So first today we'll see staff advances. A company gives loan or advance to the staff either at zero interest or at a very low rate of interest. Somewhere in that there is a employee compensation cost involved. So first we will find out the fair value of the advance using market rate of interest for similar loan. Fair value is equal to contractual cash flow into market rate expected. So suppose this comes to 8 lakh rupees, fair value comes to 8 lakh, and then we'll see how much was the loan actually paid, 10 lakh minus any fair value 8 lakh. The difference will be treated as staff cost. The difference will be treated as staff cost. If the amount given as advance to staff is more than the fair value or the present value using market rate, the difference is treated as staff cost. The staff cost, what is the further treatment of that? Any excess amount paid will be transferred to P&L account if service condition does not exist. If there is no service condition, employee is not required to complete any service condition, then in that case you transfer it to P&L account. But if there is a service condition, then it will be treated as a prepaid staff advance. If there is any service condition like he has to complete 3 year or 6 year, it will be treated as a prepaid staff advance and it will be written off, amortized over the service condition in SLM method. So the entry will be employee benefit expense account debit to prepaid staff advance account. Every year you will have to write off that prepaid staff advance. Now the student has a query here, what are we supposed to assume? Because the institute does not mention whether service condition exists or not. So whatever you want to do, then you have to write an assumption. If time permits, then you can write both the answers. But I am sure you won't have time. So it is better to write a note and solve the problem. Sometime employee contractual cash flow may be realized by way of adjustment in salary package. So instead of employee repaying you the loan in cash, it may be adjusted against the salary payable, no problem. Some exam question have this adjustment. Employee prepays the loan or makes part repayment of the loan. The loan was given to employee for 10 years, but he may come after 6 years and he may repay some portion of the loan in advance. So what will I do? I will calculate new fair value. I have to again compute fair value based on remaining future cash flow multiplied by original market rate of interest. So I will recalculate the fair value now. I will compare with book value, calculate book value of staff advance and prepaid staff advance on the date of prepayment. Find out the book value of staff advance and prepayment of staff advance, if any. The difference between book value, which is there in the ledger, fair value which we have computed based on revised cash flow, will be either adjusted in P&L account, if no service condition exists, or will be adjusted in prepaid staff advance account if service condition exists. So this portion is very important. Please watch it again in your free time and a day before the exam. Amortization of staff advance will be on prospective basis. So whatever balance remains in the prepaid staff advance account, that will be adjusted prospectively. Another area is security deposit given in business under off market terms. Usually you will find, let us say you have taken a premise on lease, so you are required to give security deposit which will be refunded to you, let us say after 5 years, once the lease period is over, and usually either it is interest free or very low interest is paid on that security deposit. So the standard is very smart. It says the amount of security deposit given and the fair value of the cash flow you are going to receive are not the same. So there is some other item involved in that security deposit. There is a difference between fair value and the amount given as security deposit, and that will be treated as per this standard. So sometime in business operation, entity is required to deposit security to any other entity for smooth access to business operation, and usually it is on off market terms. So first we will see if it is on market terms. On market terms means as per the market, no hidden amount or value included in that. So in that case there is no special treatment. You will pass an entry security deposit account debit to bank, amount paid plus transaction cost. But institute will not give you on market terms. They have to extract money from you, so they will give you question which will have off market terms, which means first you will have to compute fair value of the security deposit using market rate of interest and agreed contractual cash flow. Then find out the excess payment. The amount paid plus transaction cost is what you have given, let us say 10 lakh, and the fair value, let us say 8 lakh, present value of contractual cash flow at market rate. The difference excess is 2 lakh. So either it will be recognized in P&L account or it may be amortized over the period, depending upon what is that item. Excess paid will be treated as prepaid asset in non-current asset, other non-current asset, which will be amortized over the period of the contract. So journal entry now will be, in future, first security deposit account debit. So you will pass an entry security deposit account 8 lakh, prepaid asset account debit 2 lakh initially, and to bank account 10 lakh. Then every year you are going to amortize that prepaid asset expense account debit to prepaid asset account, and this will be transferred to profit and loss account, and security deposit will be unwound. So every year I have to calculate finance income on the opening balance, and I will pass an entry finance security deposit account debit to finance income, and finance income will be transferred to profit and loss account. It is called unwinding of discount. And finally on maturity, security deposit account will be realized, and you will pass an entry bank account debit to security deposit account, being amount realized. Now I will tell you one more question which they have asked more than once in the exam is intercorporate loans in groups. Holding company may give loan to subsidiary. Subsidiary company can give loan to holding company, and usually it may be given either interest free or they may charge a very low rate of interest. So first we will take an example where parent has given loan to subsidiary. Okay, so it requires some special treatment if it is not at market terms, because somewhere some other consideration is also involved. So first we will see short term loan repayable on demand. Again we'll divide into two types, short term and long term. Short term loan repayable on demand. Short term loan repayable on demand, it can be parent has given loan to subsidiary or subsidiary has given loan to parent company. In separate financial statement, whether it is parent has given loan or subsidiary has given loan, financial asset will be recorded at amount paid plus transaction cost. One party and other party will record at proceed minus transaction cost. So one party who has given the loan, financial asset to bank, amount will be amount paid plus transaction cost. The one who has received the loan, bank to financial liability, amount is proceed minus transaction cost. If it is short term or repayable on demand, then we will not record finance income or finance cost. No IRR calculation is required. No present value calculation is required. So very simple accounting in SFS of the respective parties. Now what will happen in CFS? We are going to set off the financial asset and financial liability. And there is no question of setting off financial income and finance cost, because they were not recorded only. Since finance cost and finance income are not recorded, question of set off does not arise. If it is a long-term loan, very important now, read the problem in the exam carefully. If it is a long-term loan, then the treatment will be slightly different. First we'll see situation 1. Loan is given by parent to the subsidiary. What will be the treatment in separate financial statement? First we will calculate the fair value of the loan, which will be based on market rate of interest and the agreed contractual cash flow. So one party will record it as a financial asset, the other party will record it as a financial liability. Then we'll calculate the excess amount paid by the parent. Excess amount paid by the parent will be treated as investment in subsidiary. How do you calculate that? So we'll first find out how much was the amount paid plus transaction cost, and I will deduct the fair value as we have computed above. The difference excess paid in the books of parent will be treated as investment in subsidiary. What about subsidiary? Subsidiary has received the excess. So first subsidiary will calculate proceed minus transaction cost minus fair value as per step 1. So subsidiary will treat the excess amount as equity contribution by the parent. Very interesting. Parent will show excess amount as investment in subsidiary. Subsidiary will show equity contribution from parent in the separate financial statement. Then over a period of time, the loan will be unwound in the books of parent and subsidiary. Now we'll come to CFS. In CFS what happens? One party is showing financial asset, one party is showing financial liability. So the financial asset loan and financial liability loan will be set off. Similarly, in the P&L account, one party is showing financial income, the other party is showing financial expense, we will set off. And one party is showing investment in subsidiary, other party showing equity contribution from parent, this will also be eliminated in the CFS. Now you will ask, what about loan by subsidiary to parent? So subsidiary has given loan to parent at off market term, below market rate of interest. So step 1 will be same. We'll calculate the fair value of the loan using market rate of interest and contractual cash flow, and will be recorded as financial asset or financial liability. Then we'll calculate excess amount received by the parent. The excess amount received by the parent will be treated as dividend from subsidiary. And how do you compute it? Amount received, you just make it minus transaction cost minus fair value. The difference is excess amount. Parent will call it as a dividend received from subsidiary, because subsidiary can give dividend to the parent by charging lower rate of interest. And what about subsidiary? Subsidiary will show it as a dividend payment to the parent. Amount paid plus transaction cost is paid by subsidiary minus fair value of the loan. The difference is called dividend paid by subsidiary to parent. And then over the period of loan, the loan will be unwound in the books of parent and subsidiary. Parent will show finance cost, subsidiary will show finance income. Then you will prepare the CFS. Financial asset and financial liability will be eliminated, will be set off, cancelled. Finance income and finance cost in P&L account will be eliminated. And similarly, the dividend paid and dividend received will be eliminated. Now, next case is called ease of payment. Ease of payment means there is no date fixed when the payment will be made. So that may be between parent and subsidiary. Parent can give loan, subsidiary can give loan, or sometimes a shareholder can give loan to the company without any repayment date fixed in the contract. Then such loan will be treated as long term in nature. Such loan, which includes ease of payment, will be treated as long term in nature. This was asked in the exam also, and this you will find in our class notes also. Highly tested in the exam, and we have already discussed the accounting treatment in case of long term loan which are off market terms. Sometimes a shareholder can give loan to the company at off market terms. Then that shareholder will recognize it as investment in the entity, and entity which is receiving loan from the shareholder below market rate, that entity will recognize it as an equity contribution by the shareholder. So today we are going to stop here. We will take the lecture remaining part of this IND AS-109 on some other day. We will announce it on our YouTube channel and our other social media. Kindly subscribe to the YouTube channel now. Keep the notification on so that you will get to know when the second part will come. So thank you very much for watching our video. Like it, share it with your friend. I have put all my heart and soul in preparing this lecture in a very simplified manner. You can compare with any other notes or teacher, and you will find they are really presented in a very simple manner. So thank you again. See you again. Bye bye.